current ratio and liquid ratio. In this tutorial, we will learn what are current assets, what are current liabilities, what are liquid assets, what are liquid liabilities, how is current ratio calculated, how is liquid ratio calculated, and how do we interpret both the ratios. Both the ratios are called balance sheet ratios as they help in interpretation of the balance sheet. Both these ratios help to analyze the health of a balance sheet of a particular firm. Hence, they are also called as balance sheet ratios. What are current assets? Current assets are short-term assets. They remain in the business for a very short period of time, generally not more than 1 year. For example, debtors. Generally, we receive the amount receivable from the debtors within 1 year. No business allows a credit period of 1 year. Generally, the credit period given to debtors is 90 to 120 days. At max, it could be 6 months. What are current liabilities? Current liabilities, like current assets, are also short-term liabilities. They are to be repaid generally within a year. For example, creditors. The rule that applies to debtors also applies to creditors. No business can afford to give a credit period of more than 1 year. What is a current ratio? Current ratio is a ratio that helps us to analyze the short-term liquidity position of a company. The formula for calculating the current ratio is current assets divided by current liabilities. It is also called as a working capital ratio. How do we interpret the current ratio? The standard current ratio is 2:1. When we say current ratio is 2:1, it means that the current assets of the firm are twice that of the current liabilities. It means that if the current liabilities are rupees 100, then the current assets of the company are rupees 200. It means that the company has a very comfortable position of working capital. It means the creditors shouldn't worry about getting their payments from the company on time. It also means that the company is unlikely to face any liquidity crunch or cash crunch if you consider a time frame of next 1 year. This is a very good sign for any company. However, if the current ratio is less than 1, then it may start creating doubts in the minds of suppliers. So it's always advisable for any company to maintain a current ratio of around 2:1 or maybe slightly higher. On the flip side, the company shouldn't have a very high current ratio also. Please remember, cash is a part of current assets. Generally, a high current ratio happens when the company has excess cash, or it could be due to the fact that the company may be giving excess credit or excess credit period to its customers or debtors. If you are giving too much credit to your debtors or the customers, then it is likely that you may face a financial problem in long term. On the other hand, having too much cash is also not a very good situation. Idle cash does not give any return to the company. If the company has excess cash, the company should utilize it for the purpose of expansion of the business, or should invest it somewhere so that it can earn some good returns on the investments. Having too much cash is a good sign from the creditor's perspective. However, from the company's perspective, it is not a good sign. It indicates that the company is not making productive use of the excess cash that it is holding. What is a liquid ratio? There are basically two liquid ratios. One is liquidity ratio and second is quick ratio. formula for liquid ratio is liquid assets divided by current liabilities. What are liquid assets? Liquid assets are those current assets which can be converted into cash almost immediately without any loss in the value of those assets. How do we calculate the amount of liquid assets? Liquid assets is equal to current assets minus stock or inventories minus prepayments. So to arrive at the figure of liquid assets, we deduct stock and prepayments from the total current assets. Cash and prepayments are the current assets which cannot be converted into cash almost immediately without any loss in their values. You cannot get rid of your stocks almost immediately. Same is the case with prepayments. Prepayments are the payments made in advance for some goods or services which we are going to receive. It's the payment for goods or services which are yet to be received by us. So it's not easy to convert the prepayments back into cash. So to calculate the amount of liquid assets, we deduct stock and prepayment amount from the amount of the current assets. Thus, liquidity ratio, which is sometimes simply referred to as liquid ratio, is equal to liquid assets divided by current liabilities. Quick ratio is equal to liquid assets divided by liquid liabilities. We have already understood what do you mean by liquid assets. To calculate the amount of liquid liabilities, we deduct bank overdraft or cash credit amount from the amount of the current liabilities. The reason why bank overdraft or CC is deducted from current liabilities is that generally the cash credit or the overdraft facility is not repayable almost immediately. Cash credit or bank overdraft facility is generally granted by the banks for the period of 1 year and then it is renewed after every 1 year. So it is extremely unlikely that the bank will all of a sudden ask you to repay back the cash credit or bank overdraft amount. Under quick ratio, we calculate the liquidity position of the company in a very near future. So under quick ratio, what we are doing is we are first deducting the bank overdraft or the cash credit amount from the amount of the current liabilities. And then we are comparing it with liquid assets, which are the assets which can be converted into cash almost immediately without any loss of value of assets. We are deducting the amount of cash credit or bank overdraft from current liabilities and then we are comparing it with current assets minus stock minus prepayments. So first we are deducting the amount of cash credit or bank overdraft from the current liabilities and then we are comparing it with the liquid assets, which are the assets which can be converted into cash almost immediately, which is current assets minus stock minus prepayment. Under liquid ratio, we are comparing the current liabilities to liquid assets, which are the assets which can be converted into cash almost immediately. So under quick ratio, we first deduct the amount of bank overdraft or cash credit from the amount of the current liabilities and then we compare it to the liquid assets. So under quick ratio, we compare liquid liabilities to liquid assets. Standard quick ratio is 1:1, which means that if any company has a quick ratio less than 1:1, it is facing a cash crunch.